and our special guest, Gina Martin Adams. Gina, I just want to make sure, can you hear me okay?
Yes, I can hear you. Thanks for having me.
Okay, perfect. All right, so let's not bury the lead, Gina. I named this space when the bear market ends, and or maybe it's just funny timing, given the way markets are acting today. But I do want to hear your thoughts on what you see are key characteristics for when a bear market occurs. And bear market is a term I'm using very purposely because I've made the argument that I think we've been in a bear market for pretty much a year now. Because if you look at the vast majority of stocks, many really started peaking out in February. That's when breadth started deteriorating, small caps peaked, emerging markets peaked, and you started getting this kind of massive divergence between large cap tech and everything else. So explain to the audience how you look at markets and how you look at when a bear cycle might be coming to an end.
Yeah. Well, thank you for the question. Very, very insightful. I think it's a great way to kick off the discussion because the way that I look at markets is market by market. So I would agree with you. If you look at the broad market, there has been a bear market in emerging market stocks and small cap shares, in most of the meme stocks, some of the high risk, high vol stocks for the better part of the year. Where there wasn't a bear market was in the S&P 500 mega caps, and to a lesser extent, the rest of the S&P 500. I think a lot of it depends upon your discipline, right? Do you really care about the market at large, or do you care about the stocks within the market? Do you care about certain sectors or styles and the meaningful signals that they can give you with respect to the broader outlook? I care about U.S. large caps, U.S. small caps, global stocks, and then all the markets within. And I think there's always a story to be had. There's a lot, in a lot of cases over time, you do have bear markets in certain segments of the market while you have bull markets in the rest of the market. And the overall stocks look like they're still rising. But I do think you have to do some individual analysis on the markets themselves as well as the constituents within. I think the S&P 500 at large did not enter a bear trend until January. I think we have been in a downtrend ever since. I also think this characteristic, so the definition of bear market is somewhat arbitrary. So I use downtrend and uptrend. We've been in a very clear series of pattern in the S&P 500 where we're making lower lows and lower highs. That to me defines a downtrend. We have fallen to a point where less than 50% of constituents are trading above their 200-day moving average. That defines a downtrend, a very weak market. RSI, a measure of momentum, has been sort of struggling to accelerate beyond the 50 level for most of this year. That also is a characteristic of a downtrend. Some might call a bear market. I don't think that you define a bear market by some 20% down means bear. I just think we're in a downtrend. And even with today's bounce, it's not strong enough to eliminate that overall downtrend yet. So I think small caps, on the other hand, have been they were in a sideways trend for most of 2021, entered a bear market in the latter part of 2021, and have also been struggling in 2022, but show an interesting recent divergence from large caps that I think is notable and certainly worth watching. We could be in a situation where small caps lead us out. Small caps made their bigger low all the way back in January and have yet to really to make a lower low. So they've been in more of a sideways trend since the end of January, after really struggling for most of the November, December, and early January period.
All right, so let's relate the small, large discussion around valuations here, because one of the arguments when it comes to small caps as to why they've performed so poorly relative to large caps is that there's a lot of zombie companies, there's a lot of overvaluation, a lot of companies should no longer exist, but they still do because of stimulus and monetary action. Talk about sort of the intersection of valuation on knowing if a major trend change is coming as it relates to market cap in particular.
Yeah. So I think that you can use valuation for some things. I don't use it necessarily for determination of price trend or trend shift, but I do look at it in the context of a longer term opportunity, or to either move toward a shorter position or a more bearish sort of position, or get a little bit more opportunistic. And the reason I say that is because small caps you can trade at a large cap, a discount to large caps for an extensive period of time. And they did so for most of the last cycle and never proved to be a catalyst. So valuation by itself, I almost never look at as a catalyst alone, right? You can have a situation, though, where you have extremely cheap valuations and a catalyst emerges for price. Usually what emerges to end a bear market is an extraordinarily oversold condition. I firmly believe that there is no real magical fundamental measure that you can find that triggers the end of a bear market. I think, stocks get insanely oversold and usually very cheap at the bottom, but that very cheap level varies considerably in every cycle. What doesn't often vary is the degree to which stocks tend to get oversold and sentiment forms bottoms. And then once you have that washout in sentiment, which in my experience is usually formed by less than 2% of stocks trading above their 50-day moving average on the major indices, that usually creates a pretty big washout, suggests that all of the participants that were, willing to sell have sold. And you tend to see buyers start to reemerge. I think the other thing to consider, though, is that every market has identifiable patterns that are quite different. One of the things that I've observed in the course of my time as a U.S. equity strategist is that large caps and small caps just inherently trade very differently. You just don't find a period of time where large cap stocks trade sideways. It just doesn't, it almost never happens. But you do find long periods of time where small caps trade sideways, and they tend to rise in big bursts and then trade sideways and then fall really quickly and then sometimes trade sideways before they rise again. That doesn't happen in large cap stocks. Large cap stocks trend, and then trend breaks, they get oversold, and then they usually trend again. So, I think that there are characteristic differences by market, and you can find those as you move through price patterns across the globe.
So I'd heard that before, though. It's interesting. Is there? Do you think that's mainly because that's driven by something structurally in the way large cap works versus small cap, or is it explained partially by sector movements or sector allocations? What would be the reasoning for why small caps, you think, tend to have that kind of a differentiating pattern, whereas, as you're arguing, large caps maybe have more trending behavior?
Yeah, I think a lot of it is the constituent components. I mean, if I look at large caps in the S&P 500, I'm looking at a pretty select group of companies that are relatively stable, very rarely actually produce losses. At any given time, I'm looking at the Russell 2000, and even in the midst of a massive bull market, you still have a significant percentage of that index that doesn't have any earnings. It's they're not actually making any money. So it's a very different kind of market. I think there also are very significant constituent changes in the Russell 2000 that don't exist in the S&P 500. So if I'm looking at the S&P 500, even Tesla took forever for the S&P 500 to embrace as a large cap company, for example. But within the Russell 2000, we had a lot of movement early last year where, with the whole meme stock craze, you had GameStop come in and out of the index. You had a lot of movement in small cap stocks that ultimately creates this very different landscape in the Russell 2000. There's much higher overall level of volatility in that index. Sector skew is very different. In the S&P 500, you often have these phenomenons where mega cap stocks, such as today, are driving an inordinate share of performance. There's less active management benchmarked to large cap stocks, much more active management in small caps. And that is representative of kind of the reality of the indices. There's just so much more movement in small caps. There's so much more alpha effectively to be derived from the small cap index because of all that movement. But I think that movement also creates a very different price pattern within the index.
You mentioned the meme stock craze, and what's amazing to me is that the meme stock movement really stopped in January of last year, and yet the craze and the narrative still is out there,
Yeah.
right? This
Yeah.
lore around GameStop and AMC, and fine, maybe these things will have, or these types of companies will have another one of these massive spikes. But I am curious your thoughts on narratives around the individual retail investor and the reality on the ground, which would suggest that most retail investors probably still are not doing anywhere near the kind of performance as just passive buy and hold.
Right. I have interest. I think there's been some really interesting sea change in the retail investor universe. Let me start with that and sort of take a step back and think about the share of overall trading that the retail investor is responsible for. And because I think there are a lot of misnomers, right? You can, any given day, you can open the newspaper and hear that ETFs dominate the world, and that's the only thing that matters anymore, or the retail investor is completely dominating the world, and nothing else is meaningful. And I think that so you can get this really false narrative based upon whatever is hot at the moment. But when we look back over the last 2 decades, what we find is retail investor participation in the equity market actually peaked all the way back in the late 1990s and had been on a steady downtrend in share of overall equity market volume pretty consistently right up until about 2015, 2016. Where suddenly the retail investor decided, hey, I think what actually happened at that time is finally we had washed out the entire psychology of the breaking of the technology bubble. We'd gone through a full generation of transition. And we had also finally recovered from the great financial crisis, and we're experiencing a period of relatively robust growth in the broader economy. But at that point in time, we started to see some significant increase in retail investor participation in the broader equity markets for the first time in 15 years. And by significant, I mean, their share in the equity market would jump 1%, 2%, 3% over a course of a year. And then all of a sudden we had COVID hit. The pandemic struck us in 2020, and in 2021 and 2021, suddenly retail investor participation shot up, and it shot up to the point where some estimates say that it doubled as a share of total trading volume in the overall U.S. equity market. Even though it had doubled as a share of total trading volume, it's still well below where it was in the late 1990s. But because it was such a big jump relative to where we were, it felt like this magnificent sea change. And it was certainly took over share of, for instance, hedge fund share of overall trading was falling. Certainly active manager share of overall trading was falling. And suddenly, so the retail investor got a lot of attention. But when we go back and we look at things like, how much did this really have meaningful impacts on the broad market? How much did retail trading really drive trends in the S&P 500, for example? I cannot find any evidence to suggest that it did. I can find evidence to suggest that it really impacted Russell 2000 because I could see the evolution of market cap for these selected stocks. And I can see how they became big enough that they entered the Russell 2000 and then they exit the Russell 2000. I can see how short interest, for instance, as a factor, drove performance for specific stocks, but I could not see how short interest as a factor drove performance for the broad market. And I think that perspective is important to consider because the narrative became the retail investor is driving everything. The reality of the situation is the retail investor is finally back and has been missing from this market for so long. They were just not participating. The other way to see this is if you look at U.S. household, and let's just isolate the U.S. Because that is my primary area of expertise. But if you look at U.S. household holdings of stocks, You go through the 1990s and US household holdings of equities on net accelerated at an average pace of about 1.5% per year. So, excluding any market gains, people were adding to their portfolio positions in the US equity market. If you take this cycle by itself, from 2009 to 2020, US household ownership on net of equity assets actually fell. Even though the market, we know we went through this magnificent bull market from 2010 to 2020, really strong gains. The US equity market tripled in value, yet net holdings on US household balance sheets actually fell in that period, which I think is just remarkable in the grand scheme of things. Investor participation just didn't exist in the US equity market for virtually an entire cycle. It really started to inch its way back, as I said, in 2015, 2016. But now it's back. And it certainly is creating some interesting fodder for discussion in the broader market. I think you are seeing retail investors have, pretty strong say in the outcomes for certain stocks and certain companies. But are we back to a point where the retail investor is really dominating the broad market? We're not even anywhere close. We would have to see much greater participation by the retail investor. And I think that perspective is just kind of important to keep in mind. For the last 2 years, just to follow up with one more stat on that point, U.S. household assets, when we look at U.S. household assets and we look at equities as a share of those assets, net holdings of equities have increased at greater than a 1% pace for the last 2 years specifically. So we are seeing more actual money being put to work in stocks, not just gains from stocks benefiting the balance sheet, but actual money going into the equity market. And as a strategist, this is a wonderful thing to see, because I've been working as a strategist, for the last 10 years in a market that was price gains were entirely driven by a takeout of supply and institutional flows. So that supply reduction was largely responsible for the acceleration in prices. Now I finally see some demand coming back with the sort of reinvigoration of the retail investor space. And, it certainly is changing the dynamic slowly in stocks, but is it the overall driver of stock prices? Not yet.
Yeah, no, great.
Sorry,
great
that was a very rambling, answer.
But that's great perspective for sure.
So on the first question, I'm perilously unprepared to answer this question. We do have a market structure team in Bloomberg Intelligence. And so what I'll do is just provide you a resource that may be able to dig into this topic for you. And that is Larry Tabb.
Sure.
Larry Tabb runs the team within Bloomberg Intelligence that actually, tracks the market structure itself, not only for equities, but for fixed income, even crypto. He's got a great crypto analyst on that team now too. So they would probably be able to give you more insight with respect to the first question. Yeah. Okay. I have not done that kind of analysis, and I'll tell you why I probably wouldn't do that kind of analysis. And that is because of the wisdom of crowds. I do think that there's a reason why we all follow price trend, right? Price trend is the ultimate manifestation of crowd wisdom. The price is, in effect, always right to some degree. In a similar fashion, I think the more estimates you can include, the more informed you are. And I would be reticent not to note that earnings estimate revision is one of the strongest factors and then we're talking about a consensus earnings estimate revision, is one of the strongest factors for predicting relative price performance of large groups within the equity market. So I do like to use a wide array of analyst estimates and include them all together. The other thing I'd say is, having worked on the sell side for the vast majority of my career before joining Bloomberg, I think that analysts over time, some analysts kill it in one cycle, don't kill it in the next. Some analysts are persistently great. But if I'm looking at thousands and thousands of analyst estimates, I'm most likely going to get directionality correct. If I'm cherry picking which analysts have been most right over 3 years versus which analysts have been most right over 10 years, I'm probably going to get a different subset of analysts. So I think that that would be an extensive project. I think it would be really interesting to potentially embark upon, but I think it also carries a high degree of risk because it ignores the wisdom of crowds. And I'm a technician as well as a fundamental analyst. I'm a technician because I do believe that there is some wisdom to be derived through respecting what the market tells you, and using an aggregated consensus is effectively the market for earnings. And we've actually found estimates, as much as some people think that analysts don't have a whole lot to provide, we've found estimates to be a pretty good guide in a lot of ways. One of my very favorite fundamental indicators that actually is a leading estimate of price, or a leading indicator for price, particularly at tops, I tweeted this one, I think this morning or yesterday, is consensus operating margin expectations. And consensus operating margin expectations have predicted every major top in the equity market over the last 10 years. You just have to watch consensus operating margin expectations for a peak forming. And once that peak forms and you see a downdraft, it all bets are off. The equity market tends to go through at least a 10% correction, in most cases, at least a 15% correction. So there is something to be said for using broad groups of analyst expectations. I find it to be very helpful and a meaningful indicator. It's never going to tell you the bottom. Right? You're never going to get the bottom out of analysts. Analysts are going to capitulate on earnings estimates when the bottom in price is happening, most likely. And we're starting to see some earnings estimate capitulation now. Good sign that maybe we'll finally find a bottom at some point. I'm not saying it's now, but nonetheless, we are starting to see some capitulation in earnings estimates. But analysts are pretty good at finding tops in stocks. They just find them with margins, and margins are not followed well enough on the street. We follow them, ad nauseum in my shop for this reason. So the reason I don't think it's all negative is because it's only happened for the last 2 years, and it's also still small on net in comparison to what happened in the 1990s. Do I think that there are distortions in the equity market? 100%. Do I think that everybody is way too overexposed to the mega cap stocks? Absolutely. Do I think that many retail investors, are going to get their faces ripped off because they're trying to trade in new markets? Of course they are, because that's how markets work. But do I think that households are irrationally exuberant about equities? Absolutely not. I don't think that U.S. households, and I could just tell you, having been in the business in the late 1990s, having been in the business even in 2007 at the top, people aren't asking me they haven't even been asking me what stock they want to buy and what stock they should go into.
Well, they're probably asking what dog money to buy from the cryptocurrency space.
Exactly. They ask me what I think about Bitcoin. They ask me, what do I think about Bitcoin? What's happening with NFTs? I even get questions about gold. And I get questions from the wealth universe, I get tons of questions about alts. What do you see in private equity? Where's this going for the long term? Nobody cares about public equity anymore. And, maybe I say this because I'm a little bitter, because I am an equity strategist. But frankly, I've been living this environment as an equity strategist. And for the last 2 years, they've started to get interested. But this isn't even like the 2007 levels of interest. This is like, there's a segment of retail that's super interested and engaged in the equity market. Everybody else seems to have found much more favorable places to put their money. Now, I still love equities and I live it all day long, and still think that this is an asset class that grows over time in consistency with the economy long term. And I have a great chart on that for those of you who want to pick through the charts that I've tweeted recently, just showing how prices and earnings actually do rise together over long periods of time and do normalize together when there are gaps made. But I just don't see this irrational exuberance. Yes, their share of their overall asset levels is back to all-time highs, but so is the stock market. I take this issue also with, there's a lot of people that put that chart in front of me that shows margin debt at all-time highs. And it coincidentally tends to come out after stocks have already corrected 10% every time. And, frankly, margin debt should grow as stock price values grow. And if you actually look at the chart, margin debt rises to a new high with every cycle and then falls as the cycle corrects itself, and then rises to another new high with every cycle and then falls as the cycle corrects itself. It's a completely meaningless indicator.
So that's interesting.
Just reflecting price trends.
That's interesting. So I want to tease that out a little bit because I think that's an interesting discussion to have. So I think a lot of those I agree with you, right? I mean, everything you're saying is 100% spot on when it comes to margin debt. I think most of the focus on the margin debt charts are around when they start to turn, right?
Yep.
That's sort of when it's not really about the level; it's about the sort of change in the trend as a leading indicator. But if let's go with that point that margin debt keeps on going to new highs as stocks keep going to new highs. Makes sense. I do wonder if that means that we're entering a period where, because we keep on ratcheting up that margin debt, that these declines feel and look more like mini crashes or actual crashes as opposed to like more prolonged traditional bear markets, right? Because I always go back to this point that the necessary precursor to a crash is leverage, right? So if you keep on re-leveraging and that leverage level keeps getting to new highs, well, then you don't really have bear markets anymore. You have these very aggressive sharp sell-offs and then nothing. Then you climb back up, then very aggressive sharp sell-off, and then right. So talk through that dynamic, because I think that's something which I think, at least from my vantage point, explains why markets seem to have this very high volatility of volatility.
Yeah. I do think I haven't done the work on it, so I don't know that I could tell you a whole lot about it. Because I am a very model driven person, but I do think if I were to sort of take a step back and think about how margin plays in the equity market, I think that you make a great point that it only matters when the market turns, because then you have exacerbated downside when you have elevated levels of margin. But there's something to be said for the fact that margin also always accelerates to a new high before every peak. And I would love to see a chart that adjusts margin for price, right? That adjusts the value of what you're margining. Because I think that maybe there's something to be said for what happens when net, excluding the impact of price, margin is a new high. But I don't know how to do that. It's certainly worth trying, because I think there may be a signal there that we could derive from margin in that instance. I haven't done the work to be able to substantiate any kind of theory around it. I just simply have made this observation that, if we're always attributing everything to that it's now scary because it's at a new price high. Well, the stock market's at a new price high, so it probably should be at a new price high.
Yeah. No, that makes sense. Okay, so you mentioned the word models, right? And
yeah.
The problem with the models, of course, is that there's always some variable that seemingly comes out of nowhere that might have been an error, but now becomes the actual variable. So, with everything that's going on in the commodity space, these kind of tails that are wagging seemingly on different days, whether it's wheat or nickel or even today oil, but on the other side, how do you factor that out, especially in the context of the earlier point you mentioned, which is that margins ultimately are a big driver of predictability for stocks? Well, if commodity prices are having this kind of tail volatility, presumably that means margins have all kinds of tail volatility too. But maybe I'm wrong. But let's tease that out a little bit.
Yeah. So how do we factor in this crazy commodity landscape? I think, it's a great question. Obviously, most of us on this call have not operated professionally in an environment in which commodity costs were soaring at the pace that they are today. I think the offset to that, and I do always want to provide kind of, the broad perspective, is that cash levels have also never been this high. And so the offset is, okay, so we're sitting here and we're looking at $4.50 at the pump. We may be looking at $5 at the pump. We're probably looking at 7 to 8% CPI. but we also have had the biggest boom in liquidity that we've ever seen and maybe ever will see in our lives. And so corporates are sitting on all-time high levels of cash as a share of their assets. Households are also sitting on extraordinary levels of cash as a share of their assets. And debt service ratios, aggregate debt to income, is incredibly well positioned to weather any storm. So I think that the trouble that we have is we look at these commodity prices in a vacuum, right? And we say, okay, what is last time we got to $150 on oil? What happened? And then we forget that even though something happened in 2008 when oil prices spiked to $150, it may not be the representative example for what could happen in 2022 because the economic and financial market conditions of 2008 were entirely different than 2022. And that's what I struggle with, is sort of when I'm trying to model out what happens with $150 oil, I can't just look at what happened last time because it's quite meaningless, frankly. We were in the midst of a financial crisis when oil spiked to $150. And we were already weakening in economic growth. We were 7 years in to an economic cycle. And so it makes it very difficult to kind of look at last time. 1990-91 is another one that's come up a lot. People say, oh, this is exactly like 1990-91? It's not even close because, again, 1990-91 followed a banking crisis. The other thing I think is really interesting about the commodity landscape right now is the portfolio impact is also de minimis. Who owned oil prior to this? Nobody wanted to own. This is the really fascinating thing about this is nobody wanted to own energy stocks last year. Everybody's kind of gotten sucked into the energy stocks. Nobody wanted to own commodities in their broad portfolio because commodities have been through a massive bear market. So it's entirely different in terms of portfolio dynamics than the last cycle was either. You know, people were gobbling up commodities going into that peak in 2008. For those of you who remember, 2005 to 2008 was this point in time where everybody was, thought oil prices would never go down. We're going to see oil prices stay high into perpetuity. You've got to have commodities as a share of your institutional portfolio. And then we went through the last decade where every institutional account shaved their commodity exposure to almost zero. And now you've got $150 oil. So the dynamics that what I was saying is, can I exactly model out what the meaning of this is? I can't. What I can say 100% certain is it's not going to fall out. It's not going to happen like last time. We're not going to see 2022 look exactly like 2008. We're not going to see 2022 look exactly like 2015 or 1990-91. There are things that we can maybe tease out of those scenarios. But the biggest thing I think to consider when you think about the impact of commodity prices on portfolios is nobody owned them heading into this. So the spike is now people are starting to catch up to it, right? People are saying, oh, we got to have this. We got to have this. But we weren't sitting in an overbought condition in commodity prices, which if we get a downdraft in commodity prices going forward, what will that mean for equities? Probably is not great for energy stocks, but it doesn't mean massive portfolio losses like it did in 2008. And I think that's of consequence, certainly, to consider. Now, the other part of your question was kind of this volatility. I don't think there's a ton of lessons between, I don't think there's a ton of interconnectedness between the equity market and the commodity market from a trading perspective. So I'm not terribly worried about vol in commodities becoming a vol equity event, except for from the fact that commodities prices are now accelerating so fast and are at such high levels that it is creating a downdraft in expectations for growth, sort of that second derivative impact on non-commodity sensitive equities. And it has created potentially some potential inflation and valuations for commodity-centric equities. But I don't think there's a ton of cross trading that happens between the equity market and commodity market. It's more like commodities are a fundamental input when we think about considering them for equities. I think on a day-to-day basis, you get a very different picture because right now commodity prices are driving sector trends and individual stock trends in the equity market day to day. But longer term, I'm not sure I would worry too much about commodity vol becoming big equity vol long term.
What's interesting about commodities is some people will argue very loudly that they are not an asset class.
Uh-huh.
And you'll have some people that will argue that it is an asset class, and oftentimes I would say most people would say it's an asset class when there's actual momentum, right? I mean, cynically, it's like, why do people want it now? Because it's performing, right? I mean, that's always kind of the I think the big differentiator. Let me reset the room one last time here, and then.
So I am worried about this scenario developing for one reason and for one reason only, because I think the Fed has lost control of the inflation situation. And I argued very loudly in 2020, maybe not loudly enough, that I'm concerned the ultimate outcome of the pandemic is inflation. And then in 2021, we talked a lot about the threat to margins of an inflationary spiral. And I think the Fed should have been tightening policy a year ago and kind of lost their chance at tightening policy. And the threat of that has become very real for me over the course of the last year, because I think the single largest threat to the equity market trend is a scenario in which inflation permanently runs at a faster pace than growth, because that to me characterizes a bear market condition or a lost decade such as that which we experienced from 68 to 82, where very consistently over that long period of time, inflation outpaced growth. And there were years and bits and points in time in which growth spurts, created opportunities for stocks. But ultimately, that's a bear market for me, where you have this long-term malaise set in. Now, I think that there are some really good reasons to not fade growth just yet. I do think that, for instance, the U.S. household, the U.S. consumer is in remarkably good shape, much, much better shape than they have been in a very long period of time. Debt service as a share of income is back to its levels last seen in 1980. For example, cash levels have accelerated materially. So we have this we've girded ourselves over the course of the last 2 years for a much faster growth cycle. And even longer than that, the household balance has been repairing itself since 2008. So we've prepared ourselves pretty well for a potentially much stronger growth cycle. But I'm increasingly worried that if the Fed does not normalize interest rates and sort of really address the inflationary situation, that we could fall into a much more nefarious condition for growth and inflation. I still give that a relatively low priority or low probability. But I will say this, just in full acknowledgement, for the first time in my career, I'm including a stagflationary scenario in my fair value model for stocks. And I have not had to do that before. I've not even had to consider it. It's always recession, recovery, expansion. And so I do worry about it. I don't think we're there yet because we're still working through the supply chain constraints as a result of the pandemic. Let's not forget that leading into this Russia-Ukraine crisis, the pandemic was the overall driver of constraint, and the pandemic was about supply chain distress. And that supply chain distress over time should ease for the broader economy as the pandemic slowly becomes endemic. And I'm still hopeful that that will relieve some strain. I mean, it was just January that the U.S. economy, nobody was going to work for 2 weeks. A good portion of Asia, Hong Kong in particular, is still struggling with some pandemic stress, but we're slowly starting to open up the global economy, and that should relieve some of the supply chain constraint. But I do worry because we've gone a year, in my opinion, we've gone a full year with no adequate Fed policy to address the inflationary situation. We've made excuses on the supply chain side for too long. We have not acknowledged the fact that growth has surged. This has been the single fastest economic recovery we've seen in U.S. history. We've not acknowledged the fact that the U.S. economy is on fire and instead leaned on this sort of idea that we're in pandemic distress. And I'm just worried the Fed is behind. And the longer the Fed is behind, the more those inflation expectations that are really driving low consumer confidence levels right now get entrenched. And the more that gets entrenched, then the more the consumer starts to really change their behavior patterns. And I am worried that we're at this critical moment where we absolutely need to normalize, at least to some degree, see some normalization of Fed policy to address the inflationary situation. And that may throw us into a temporary recession. But that's much better than a long-term stagflationary outcome, which I do think is a real possibility. And I don't think it's a high probability event yet, because we were too early in the pandemic recovery to really understand what these supply chain constraints are and how persistent they are and how much they make clear. But I think, and I also think that demand is going to continue to surprise us for quite some time. Look, we've been through oil prices in the $80 to $110 range. We sat there for 3 years from 2011 to 2014 when the economy was significantly smaller than it is today. So 80 to 110 is nothing. We know this. We did that. It didn't create a recession. But have we sat through $120, $130, $140 oil for an extended period of time? No. Have we sat through 7 to 8% increases in CPI for a persistent period of time? Absolutely not. And so some of this is very new. And I am certainly worried about it. I don't want to make it my model. But there is a non-zero probability that it happens now. And 2 years ago, I would have said stagflation is next to a 0% probability.
I'm curious, maybe in the final few minutes here, to get your thoughts on the way the dollar's behaved, because that's one part which is curious to me, right? So traditional thinking would be commodities rally as the dollar declines because of the dollar denomination.
Yep.
You've had commodities rally and the dollar rally. Traditional thinking would say that, stimmy checks, unrelenting stimulus from the fiscal side, from the monetary side, would cause the dollar to break. It didn't, right? And I had Brent Johnson on a space before. He has this, dollar milkshake theory, this idea that you have a sovereign debt crisis where the dollar goes up and U.S. markets go up as the beneficiary of, just flows coming from overseas to the U.S. But what do you make of the tightening cycle that the dollar seems to be putting in when the Fed really hasn't done anything yet, and given the inconsistencies with other asset class movement?
Yeah. Well, I think the dollar, the one big thing that the dollar does for me as a signal is that it's the risk off signal du jour and the risk on signal du jour, right? And so when the globe gets scared, they call on the dollar. That's the way that I think about it. So in times of distress, in times of fear, the dollar tends to rally. In times of joy, in times of, optimism, the dollar tends to sell off. And so I view it as the ultimate risk on, risk off signal. I think we did go a long way to pricing a tighter Fed with the dollar. And so the Fed is not as meaningful as an impactor for the dollar right now as the global, as what's happening in Russia, Ukraine, which is creating this risk off mentality in the globe, which is benefiting the dollar and certainly also benefiting the 10-year. Treasury and U.S. Treasury bonds as a result. I think in the grand scheme of things, we did some research on the dollar this week because people started asking me if, this dollar move was going to be really damaging to U.S. S&P 500 earnings. In the grand scheme of things, the dollar's up 7.5% over the last year. It's a pretty meaningless gain, frankly. It's moving around a lot, but the dollar's been in this trading range of roughly, I think it's about 89 to roughly 103 since 2016. And we're still in the middle of that range. Long term, I think if I remember my statistics correctly, the dollar moves, year-over-year change in the dollar can range from negative 17% to positive 23%. So we're up 7.5% year over year. And I think the most recent rally has been reflective of, first, we were pricing in a tighter Fed. And then over the last couple of weeks, we've priced in a lot of global risk that's emerged. But I'm not too worried of the dollar right now. I think if you get over that 103 price ceiling, which has existed since 2016, it could be a very different story. This dollar move is really modest in comparison to that really rapid surge that we had in 2014, 2015, which did create some distress for corporate earnings and was very consistent with the crash in oil prices that we saw over that time period. So far, it's pretty benign in the grand scheme of things.
Interesting perspective. Again, everybody that's here, please make sure you follow Gina and her research, obviously, on Bloomberg. All right, so I'll end it with this one last question, just given the voluminous amount of data that you look at. What would you say to the audience is the sleeper indicator, the thing which nobody's really paying attention to, that if it starts to behave in a certain way would really be a tell of regime change? What's sort of something that you think is a wildly important data point that most people are not really looking at right now?
Oh my gosh, this is such an unfair question.
I know, I'm sorry.
Okay, what data point do I think nobody's looking at and would be very meaningful to watch? So, I'll be really generic because I don't know that there's anything specific that I would point to that the consensus doesn't, that nobody watches, except I don't think people watch margin estimates closely enough. And I alluded to this earlier. I also don't think people pay enough attention to what's really happening in earnings. There's one stat that I will leave you with, and that is from our pre-pandemic peak, so go all the way back to 2019, very early 2020, from our pre-pandemic peak to date, S&P 500 EPS is up 31%. From that pre-pandemic peak to date, S&P 500 price is up 28%. So earnings are extremely important to thinking about where you go with price over long periods of time. They move together over long periods of time. If you can gather any kind of confidence that corporate America is going to be able to absorb these commodity cost increases, that you're going to continue to see revenue growth come in, those figures that I just gave you should give you a lot of confidence in the outlook for stock prices. If you think that earnings are just going to fall through the floor, and by the way, to see earnings fall through the floor, you've got to see revenues deteriorate. Revenue growth is accelerating 9% year over year, even into the first quarter of this year. You have got to see earnings growth deteriorate because operating margins are only going to shrink so much with tax policy where it is. Tax policy has been the primary contributor to operating margin growth over the last couple of decades, along with the constituent changes in the S&P 500. We didn't even get to that, so maybe next time we'll get to that one. But I would watch earnings trends very closely because they are very meaningful for driving price over long periods of time. And you need to see that revenue line deteriorate a lot before you get too bearish on stocks.
Yeah, that's a great way to end it off. Again, everybody, please make sure you follow Gina. And Gina, thank you for spending the hour here. It's been too long since I think I last saw you at the CMT symposium. I think it was pre-COVID.
Absolutely.
But,
it was very
all right,
great.
Thank you, everybody. Thank you, Gina. And